We want to a little bit, first and foremost, remind people of your story.
Sure.
Why the Coterie was born, and it was through frustrations that you found as a founder, right?
Yeah, so I was the founder of a company called Aptiv before this. We were growing, we did about 100 million of revenue, and I turned off my salary and I went to apply for a mortgage. And the guy says to me, we can't give you a mortgage, you don't have a salary. And I realized it's kind of silly because most of the people that I know make a lot more money from their assets or their equity than they do from their salary, probably a lot of the people that watch your show. And so there's clearly a disconnect that's emerged between the way that the legacy financial guys think about risk and think about asset allocation and the way that me and everyone that I know thinks about it. Because most of us make most of our money from carry or equity than we do from salary. And so we realize there's an opportunity to build financial products targeted towards people who make more money from assets than they do from their salary.
So you're looking at an individual in a different way at their own credit risk, but then you're looking at that individual and being like, I know, you need diversification in your life as well.
Well, if you think about a founder, most of their wealth is concentrated in one specific highly illiquid asset. And anybody will tell you that's not a great way to manage your risk. So what we do is we provide access to invest in some of the best fund managers in the world, like Andreessen Horowitz, like Initialized. And it allows a founder to diversify their risk away from just their own company. We also provide liquidity. We also provide estate planning. We're looking at all the different areas that founders need help in and where we feel like the banks have dropped the ball. And we're building products designed to help founders alleviate some of that mental pain that they have to experience when they try to deal with a legacy institution.
Dare I say, at this moment where one is a founder, do they want to be doubling down in still private companies, given valuations are indeed under pressure? Yeah,
so it's key that their portfolio, well, in my opinion, is that their portfolio is not just going to be privates, right? They're going to have a 401k, they're going to have publics, they're going to have probably some crypto. Our pitch is not that we're trying to provide advice as to how you construct your portfolio. Our pitch is that if you want access to some of the best privates or some of the best managers, this is the place to get it. And you couldn't really invest in Andreessen Horowitz or some of these other funds managers that we have prior to the Coterie coming around. And so we're there as an access play as opposed to an advice play.
How deep does this sort of democratization go? Because you're focusing on a very specific sphere of investor,
Today
right?
We are, yeah. Today we target people with 1 to 50 million of assets.
And what about, therefore, when you're looking at, well, ARK is getting into the space of wanting to make venture investing more accessible to those who only have $500, who aren't an accredited investor. Are you looking at democratization to that level, or are you still very specific?
No, we're focused on a specific band, but more importantly, we're focused on a specific type of person. So honestly, the band is less important. It's more about how you make your money and what your ambitions are for the future. I think if you can get access through, I think ARK's partnership was with Titan. I think you can get access through them. That's excellent. But we're looking more at someone who has a comprehensive set of needs. They want diversification. They need liquidity because of all their assets are tied up in an illiquid asset. They need tax planning because they're sitting on an asset that has potentially 1,000x appreciation and they haven't done any of their estate planning. Those are the kinds of needs that we solve as opposed to someone who's looking to dip their toe into venture for the first time.
A huge check to be written for a total addressable market that is what?
Massive.
Is it? Yeah, so talk to how big is that? Because I'm thinking, well, this is a pretty unique, relatively privileged part of society.
In America, there's 25 million millionaires. About 3 million of them are under the age of 45. And we go after people 25 to 45, 1 to 50 million of assets. And so the N of people we're talking about is a couple million people in the United States. Okay. But the most important thing is that the lifetime value of these people is extraordinarily high, right? So we're not building Bank of America. We're never going to have 150 million customers. That's not the game we're playing. We're going after a very specific demo and offering them very specific solutions that are going to make their lives easier. And if we're right, and if we do a good job, they're going to stick with us for decades. We're trying to build decades-long relationships with our customers, which will generate, hopefully, lots of lifetime value for them and for us.
Okay, so at what point do you not, how do you stop people checking out and having the family office or starting to move on to a different level of private wealth manager?
I think it really depends on what they need. So if they like a family office, which provides a lot of things that we don't, by all means, go use a family office. We're looking for people who are struggling with the solutions that are currently available to them relative to what they want. And so if you're looking for access, if you're someone who likes to do your own investing or likes to think about solutions yourself, as opposed to someone who likes to give it to a family office and say, I want someone else to manage it, there's nothing wrong with that. That's just not the space that we're in. So if you choose to graduate there, by all means, go ahead.
This, of course, is a long-term bet, and you are building a business for decades, not a year. But how has the fundraising process been, or how has your current outlook had to just cool down a little bit as the market cools down?
Yeah, look, first of all, this is my second time around, and it's a lot easier to start a company and raise money the second time around. I also have two phenomenal co-founders, both of whom this is their second and third time around. So I think what we'd say is the market is still open. There's still dry powder to be allocated. The best funds are still investing. You just have to make sure that your story and your substance is tight. And what we found is, some of the stories that were perhaps a little bit lighter that were getting funded 12 months ago maybe are not getting funded today. But the ones that still have a lot of gravitas behind them are going to get funded. And in a way, they're actually more attractive because that powder needs to get invested somewhere. And they can't be sitting on the sidelines, so they need to allocate that powder into really good companies. And I think you've seen, today and even in the last couple of weeks, the market's picking up, and a lot of companies are raising reasonably large rounds.